welcome to the Everyday Real Estate Investor Podcast. Ben Nelson here. Thanks for tuning in for another episode. As I mentioned on the podcast last week, Grant wasn't feeling well, so we had to postpone that one, but glad to have him here this week so we can get an update on everything that's going on in the lending world, because there's continues to be a lot going on. We're in a market that seems to be changing almost on a daily basis. So we definitely need to stay in touch with that and what's going on and how that is going to affect things down the road as investors, right? So thanks for being here.
Yeah, thank you for having me, Ben.
Yeah.
Always glad to be here.
Awesome. I'm glad you're feeling better. So so let's talk about what's I think you were on what it's been almost a couple months now, I think, since you've been on. Yeah. So lots happened. What's the latest in the lending world, and what have you seen change between when you were last on and now?
Yeah, probably the biggest news affecting mortgage rates is inflation. I mean, there was already with CPI, the Consumer Price Index, and the Producers Price Index, PPI, there were projections for inflation to come in low from where it's continued to climb these last several months, the last several reports we've seen. But it actually came in even lower than expectations. And we saw mortgage rates probably 2.5-3 weeks ago drop in a single day 0.5%, which was a very welcome sign when rates have we continue to see things climb month after month these last 8, 9, 10 months.
Yeah, great. It's funny because you see the rates dropped and you see the comments and the narrative and like, oh yeah, well they dropped 0.5%, but look at how high they still are, right? Granted, I said the same thing when gas prices came down, and it's like, okay, yeah, but it's still higher than it was 2 years ago or whatever, right? So, so guilty, but I think the point is that it's a good sign overall, right? Because we were consistently seeing rates going up and up and up and up, and it's like, well, when is it going to end? Are we going to end up in the 8% range? Are we going to end up in 9? I mean, where is this threshold? And I think Lawrence Yun came out, and I don't remember what all the parameters were, but basically where certain thresholds were really close to being hit, where it's like we weren't going to stop, and it was going to end up being like 8.5-9% because whatever, I don't remember what the factors were, but that was a couple weeks before we saw it actually drop back down, so it was good to see. There were some projections out there that we could be in the 8.5-9% range, and to see that pullback, I think that's the point. Is yes, obviously they're higher than they were this spring, but the fact that they stopped climbing and pulled back a little bit is a good sign moving forward, right?
And as inflation goes, so will mortgage rates follow, because bonds, where mortgage rates are based, really like seeing inflation coming down. And one of the primary drivers of the high inflation numbers these last several months has been shelter inflation, which is your rent growth, your price growth of homes. As that is lagging typically several months. So it peaked just a month or two ago, and as that continues to decline and other costs of goods are going down, if we get another lower than expected or low inflation reading in December, that's going to bode really well going into 2023 for mortgage rates.
Yeah, that's a good point. You're saying house prices, right? What are you talking?
Well, as shelter inflation comes down, inflation in general, your core inflation, which strips out your volatile like food and energy pricing, because oil is always at the forefront of people's minds, and that will go up and down. It doesn't trend as much with the general economy. As inflation just at large continues to come down, we'll see mortgage rates continue to move lower headed into the new year.
Okay, so and I had another, I guess, so where my mind was going was cost of goods, and so people only have so much expendable income, right? So we're seeing, I think we've saw this double or triple whammy, or however you want to look at it, mortgage rates going up, so housing costs are up, energy costs going up, food costs going up, everything going up at once. Well, that has to have a pullback effect in price, and we have seen median home prices drop in a lot of metro areas. Nothing like a crash, definitely more correction level, but I think as those things level out and as people feel a little bit maybe more relief in some of those areas, plus mortgage rates coming back down, they're going to feel a little bit more free to be able to go and spend money and buy a house, and then that will probably level out housing prices as well. So
Indeed. I mean, Portland Metro, I mean, we haven't seen a huge correction. I mean, there's been a cooling off more than anything.
yeah,
Your big markets like your Seattles, your Boise's, your Phoenix, they're correcting because they were way over their skis and with appreciation the last several years and coming back to more normal, but which is healthier for the market. It would be really
Absolutely.
nice middle of 2023 if inflation keeps coming down to find ourselves in the mid fives, kind of a middle ground, not the polar extremes of the twos or the sevens, but kind of a middle ground that lends stability to the housing market. But also
Absolutely, yeah.
a 0.5% drop or a 0.5% rise is not healthy for the market. That just shows how volatile the bond market is right
Yeah.
now, how volatile the stock market is, and to have more stability, more calmness in the markets and be in the mid fives. I think we're going to see a rush in demand when things become more affordable into the market, but to have a little more stability and not one day your mortgage payment's here and it's 3/8 to 5% higher and $200 more. People know what to expect, and that having a little more certainty will hopefully also encourage buyers to jump into the market.
Yeah, absolutely. Yeah, and I agree with you. I think we were definitely not in a healthy market. It was I don't know if it was great as a real estate broker, but it was interesting for sure, right? You're managing all these like super high competition and all these offers coming in well over asking. None of that's healthy for the market. It's not fun as a buyer. House shopping is always stressful, but I mean, especially for your personal residence, like it should be a fun experience, and it really wasn't.
Yeah.
It was completely slanted towards the seller, and it's just not. You need balance in the market, and we definitely don't want to see back during the financial crisis. It was the other way around, right? It was sellers begging buyers to take their property. And we saw the complete opposite of that the last few years. Well, let's get to a market that's maybe a little bit more even playing field, where seller gets a good price, buyer gets what they want, they have a little bit of room to negotiate, actually have a conversation back and forth, come to a fair agreement based on what the house is and the condition, and not just, hey buyer, do you want it or not? And yeah, there's $30,000 of deferred maintenance, but okay, take it anyway. So yeah, a balanced market, and I agree. I think we'll be there, probably heading into spring. So, so on that note, where do you see, crystal ball, right? Where do you see the trends heading, and what do you see heading into the new year and into the spring and summer markets, and then what could happen between now and then that could potentially sway or affect that?
Yeah, certainly don't have a crystal ball, but yeah, I love being deep into the economic news and listen to people like Logan Monoshami and Barry Habib, people that are in the data every single day. I mean, some of the large factors at play, I mean, the Federal Reserve has their hand in everything, kind of their monetary policy going forward, in conjunction also with what's happening at large with China, Taiwan, Europe and their energy crisis, Russia, Ukraine. There are some things that could go on internationally that could affect us here in the U.S., but I mean, by and large, what we're seeing in the trends is definitely if inflation is continuing to come down. I've seen projections that we could see those rates in the fives by Q2 of next year because, one, the spreads are so large right now between mortgage rates and the 10-year Treasury. Like we're 2.75 to 3% when a typical spread is 1.7 to 2% because there's so much volatility in the market and there's so much uncertainty. They're hedging, so there's a bigger gap. So as inflation comes down, as kind of things stabilize, even if the economy is heading into recession next year, you could see mortgage rates stabilize and secondary investors head to bonds in times of uncertainty or in times of recession because they know, okay, I can get a 3% or a 3.5% return on a U.S. Treasury, the safest investment in the world. I could really see, rates. Q2 is pretty quick to have rates back in the mid fives for primary residences. I always want to be conservative when I'm talking with clients because we do have a lot of investors, a lot of house hackers still buying right now because it's a good time to buy where There's not a lot of competition.
Mm-hmm.
You're getting maximum
Absolutely,
seller credit.
Mm-hmm.
If the numbers work right now, still a great opportunity to buy, knowing that, okay, in 12 months or less, there's going to be an opportunity to refinance. And I don't want to paint the picture that, oh, it's going to be 6 months and in quarter two, you're going to be able to refinance to a 5. But my thought process has been, it's probably going to be by Q3, Q4, end of next year, we're going to be back into the mid-5s because the Federal Reserve still has a little bit to run. We could their next meeting here in December, anticipate maybe a 50 basis rate hike, and they're slowly tapering off their rate hikes because their rate hikes have a 4 to 6 month lag and they're affecting the economy. And we're just starting to see the effects in the economy. Some of the layoffs that have been announced in the last couple of weeks of the original rate hikes they began in the summer.
Yeah.
So.
Yeah.
Yeah.
Okay.
Lot to unpack there.
Yeah. I'm trying to do that myself right now. So, yeah, a lot there for sure. So what are your, I guess you touched on a little bit in there, what are you advising your investor buyers or even your homeowner buyers as far as loan products and good strategy for buying right now with like kind of the future in mind? You kind of touched on it there, but expand on that a little bit.
I mean, I'm personally buying. I think it's a great time, encouraging investors, and not just a sales pitch to go out and buy real estate. Now is a very good time to buy because you can pull the lever of seller credit. You can pull the lever of negotiating on purchase price and win a deal on your terms. Whether someone it's a great time to house hack right now. A lot of FHA, VA loans, we're losing to all cash the last several years. Though I've had a lot of clients that are winning with those offers on duplexes, triplexes, quads right now. Using our 10% Academy Investor Loan is another. I've had a lot of people using that to purchase properties. But really with the thought being that kind of now is a golden time to buy because builders are slowing permits. They're slowing starts. You have certain markets that are back to 2019 levels with 4 months of inventory and days on market are up. But like in the Portland Metro, we're still right around 2.5 months. Yep. And you have all this...
4 months, by the way, is still, that's a fairly equilibrium level of inventory. I mean, it's not, we've had 1 to 2 months or less of inventory in most of these markets for so long. You know, we forget that 4 or 5 months is actually it's not a bad thing. Now, if it starts getting up 8, 9, 10, 12 months, then that's a problem. But 4 to 5 months is pretty normal. 07, I think we had 18 to 20 months of inventory at one point here in Portland. So it was.
But the moment you have all this pent up demand, people holding back for affordability reasons, sellers not selling because they don't want to trade into a 7% from a 3% rate, and you could have a lot of pent up demand coming to market. You really could see bidding wars again, and that supply getting sucked up
but
very
at
5.5%
interest rate instead of at 3%, right? So
yeah.
that won't come back because unless we get back down to 3%, but not necessarily true, right? We still have a very low, and again, market specific, right? But in general, a lot of major metros have a housing shortage still, and so the need and the demand is there. We've just taken the capacity to pay aspect of demand out of it or made it more difficult because people can't afford, the affordability factor's not there. But when that comes back around again, prices have adjusted a little bit, interest rates come back down. Now we're going to be in that same spot. As you said, people are not, now there's always an excuse not to sell, right? 8 or 9 months ago it was, I can sell in a day, but I can't compete to buy. Now it's well, I don't want to get rid of my 3% interest rate for 7, which totally makes sense. But so you have people holding back because of that. You have builders, like you said, that are being more cautious and holding, permits are down. So we're not adding more supply in that, or we are, but just not as much as there could be. And so the demand is still there, it's just waiting, and then the supply is not going to be there necessarily in the way to meet that demand when the floodgates open back up again.
I mean, the hope that would be that we would learn and not be waiving contingencies and going crazy like the last 2 years. But still, you're going to have potentially 3, 4, 5 buyers and more competition for homes and be more in bidding wars then compared to where you're on now, where it's just you and the seller negotiating on price and seller credit. You would hope there's not that waving of contingency. There's a healthiness in the market.
Maybe even rates in the mid fives and still getting a seller credit to buy it down even further. Like that would be crazy, right?
Yeah.
That would be get back in that 4% range or something, right?
Yeah.
Yeah. So I think that's definitely a possibility
Yeah.
in an equilibrium market, in a fairly even market. I think that's definitely realistic to expect.
I mean, you have your two largest generations, Gen Z and millennials, coming of home buying age. So
yeah.
There's a lot of demand for years to come, and we've been underbuilt for the last decade. So it'll be really curious the next several years how that plays up, if how we catch up to that supply and demand imbalance that we're currently at.
Yep. Yep, absolutely. Well, let's see. What else is on your mind about lending? Anything new on the horizons?
I mean, rates are the temporary driver with affordability right now. But, I mean, supply and demand, I think, for years to come is going to be the primary factor that influences the market at large. Nothing crazy new with lending. I mean, we're using tools like 1021 temporary buy downs, 321 buy downs, where you have a seller pay for your prepaid interest. Say on a 2-1 buy down, your par rate is 6.5%. In year one, on a 2-1 buy down, the seller's paid for all that prepaid interest in the form of seller credit. You're at 4.5% for that whole first year, and then year two, you're at 5.5%, and by year three, you're back up at the note rate of 6.5%. With the theory being, in the next 12 to 18 months, maybe even before you've adjusted that first time to 6 or to 5.5%, you will have refinanced into a permanent 30-year fixed rate.
Yep.
I'm using a lot of that because clients can drop their rate 2% instead of, on a permanent buy down, just buying the rate down to 0.5 or 0.75%. They can get a lot more bang for their buck in the short term, knowing that there's going to be an opportunity to refinance.
Yeah, and so there's that strategy, right? It's like, well, you can get your rate down with that same buy down money, right? You have $10,000 or whatever it is, seller credit. You can buy down your fixed rate, or you can just roll the dice a little bit, but with some education and some making an educated decision on where you think rates are going. That makes more sense to do this. I'll get a lower payment, and I'm buying the fixed down doesn't make sense because if I actually think rates are coming down, I'm going to refinance in the next couple of years anyway, so why would I spend all that money on this? I can save more money now over the next year or so. And
you're still qualifying at the note rate, the higher note rate.
That's a good point. I'm glad you brought that up, because I think that's where people, we're dusting off a lot of these tools from back in 2005, 2006, kind of, but not. They're not the same, right?
The last time this was relevant was probably like 2018, where we had rates elevated into the 5s temporarily.
Sure. Well, yeah, I guess so. Like in 2004, 5, 6, when they were doing the teaser rate stuff, the adjustable rates, and people hear about all of these strategies, these tools that's what they are. These are lending and loan program tools.
Yeah.
But there's been nuances that have changed in them, and I can't speak particularly to that loan, but just I think people lump them all together kind of a lot of times, where it's like, this is not a conventional fixed rate loan, so it's the bad type of loan, right? And it's like and so your point was, on that 2-1 buy down, you're still having to get approved based on the higher rate.
Correct.
It's not like you can only afford it based on the lower rate. So hopefully you get a raise between now and then. I mean, that's what they were doing essentially back before the financial crisis was, well, what rate does it need to be to qualify you based on the income you say that you make and don't actually make? And then that's the only way you qualify, and then when it adjusts, you're screwed, right?
Yeah.
So, but that's okay, because the market's going to keep going up, and then so it's a lot less. Yes, there's some looking ahead and some strategizing and seeing where things are going, but it's not like completely speculative like it was back then.
Yeah.
Hopefully the market keeps going up, otherwise you're going to be in trouble, and then everybody was, right?
Yeah.
So, yeah.
The underwriting guidelines are much more sound. I mean, just another reason why the housing market is so strong and so supply and demand, number one, but you have lending guidelines. You're not having poor subprime loans that are being written.
Yeah.
And
I think people hear that, and I think I get it. It's coming from someone in the mortgage industry, someone, and from a real estate broker.
Mhm.
So, are we biased? Maybe, but I think we both try to guide people, and tell people what we really see, right?
Yeah.
And I feel like people hear that and well, yeah, but you've got skin in the game, or you're biased because you're in the industry or whatever. But
Mhm.
it really is true that guidelines change, and well, taxpayers are the ones that got hurt, but the lenders, they don't want the repeat of that either, right? And I think you also saw that back in COVID,
Mhm.
which we probably talked about in one of the previous ones, where they were cautious. They were being really cautious.
Things tightened up.
Yeah,
so
it tightened up
quickly,
really quick, which that's a double-edged sword too. You take liquidity out of the market, but they were being careful, right?
Yeah.
Versus just continuing. And again, builders are doing the same thing. So I think people, these companies, these lenders have learned some of it by their own experience, some of it forced by regulation. But regardless, it's definitely not the same.
And I
scenario.
still always want to caution buyers, and that 2-1 buy down is not for everyone. I always want I want them to be comfortable with their budget, and I want them to know, hey, okay, you're at 4.5 now. If you don't refinance before a year, okay, you're going to be at 5.5, and after 2 years, 6.5. And I don't want them to be banking on having that 4.5 to feel comfortable with their budget,
Right.
like still being okay.
Like if I can't refinance, then I'm in trouble.
Like if rates still stay elevated for some reason, if there's some economic factor internationally that affects rates to where we don't come down as quickly next year as we thought, and they're in a 5.5, like I want them to be aware of that. And
factor the worst case scenario, right, and be okay with that, but hope for the better.
And I didn't promote the loan solution as much when we were continuing to see inflation climb, because inflation is a big driver of interest rates, and not knowing, okay, when are things going to turn. But the last several months, as we started to see inflation come down and start to see kind of a silver lining or some hope on the horizon as rates are coming down, it made me feel more confident to say, hey, this is a viable solution if you feel comfortable with it. If your payment's here, it's a good way to get your payment lower now. If you're comfortable with a slight higher payment in your budget, hey, this could be an awesome tool for the here and now to help you buy a home and be comfortable with it.
And for those of you listening, and maybe you don't have a mortgage broker that you work with, this is all key stuff that you need to make sure that they're doing for you, is not just fitting you in with whatever product they think is best, right? Mm-hmm. Is to give you options and explain them to you, and say, okay, this is how this one works. This is the scenario where it works out the best. And give you options and let you make an educated decision, and not just say, oh, you're buying this, here's the best product for you. And just not to name company names, because I really want to, but the big companies out there that are just pushing paperwork, and they have customer service reps on the phone that they have you fit in a box and they run it through, and they're not advising you, right? Yeah. They're not guiding you and helping you make an educated decision. They're more or less just fitting you into a loan product.
They're not a mortgage advisor. They're
and
taking your application and they're spitting out a rate quote. They're what we call order takers.
Yeah, and anybody can do that. Anybody can do that. They're customer service reps that are answering the phone, and someone behind the scenes is pushing the paper and all that, right? So it's not in your best interest, and they might be a little bit less expensive in some circumstances, or have some incentive that's a little bit better. But is it better if you're not getting the right loan product? It probably isn't. So cheapest or best deal, quote unquote, is not always the best. You want to know what you're getting into, and that is the best loan option for your scenario.
There's so much more value to a loan officer than just the rate and cost on a piece of paper. Their knowledge of guidelines, their expertise, ability to navigate underwriting, but also just to explain and walk someone through their different options and provide those different options where it's digestible for the consumer. That goes a long way.
Exactly. Yeah, it's just like as a real estate broker, if your expectation is that your real estate broker is going to put it in the RMLS and put a sign in the yard and that's all they're going to do, go to a discount broker. Go sign up for a flat fee listing. That's not what I do.
Yeah.
That's not what a good realtor does. A good realtor advises and knows how to market the home, how to position it properly in the market, and it's the same thing on the lending side. It's not just running it through and doing the basic paperwork. It's advising and guiding and helping them strategy, especially if you're an investor and you have multiple steps. Hey, I want to do this and I want to do this. Yeah. Tell them that. Tell them your goals. Don't just tell them, hey, I'm buying this property. Let them know what your plans are moving forward, because what you do on this first one could affect what you were able to do down the road, right?
That's one of my favorite parts of my job, is helping people plan out. Like if they have a goal, they want to take down 2 or 3 properties in the coming year. That's always one of the first questions I ask. Like I want to know, when I get introduced to someone and someone's referred my way, I want to tell me a little bit about yourself, but tell me what your goals are for real estate going forward. And like I have investors, like come tax time, like February, March, April, they're sending me a draft copy of their taxes. So we're trying to make sure they're optimized, whether they're self-employed or they're a rental property investor, that the income on that tax return makes or breaks their qualifications for buying properties in that year.
Absolutely.
And reviewing that ahead of time, planning out. I mean, I have clients that I've done 3, 4, 5 loans for in the last several years, and I love being able to help others build generational wealth, and having a mortgage advisor in your back pocket, someone who will do that for you, is really important, especially if you're an investor trying to build your portfolio.
Absolutely. Yep. And I think, again, that's the key, is looking at all of these people, your broker, your real estate broker, your mortgage broker, everybody is part of your team. You got to guide them and direct them and tell them what your plans are, but they're not there to just give you a product, put a sign in your yard, all that stuff. They're there to help you achieve those goals and put the plan in place to make that happen, and be an advisor. So if they're not doing that for you, whoever you're using, you need to maybe find someone else. Well, great. Optimistic about the market overall then?
I'm very optimistic. I'm excited.
You're buying.
I'm buying.
I'm always buying, because it's always a good time to buy. So
I'm excited for clients that are taking action, because people are creating wins right now. I mean, the winter is a naturally slow time in the market, and there are lots of opportunities to be had for those who are taking action and not listening to the fear mongering of the media, taking action and running the numbers for themselves, making their own calculated decisions. Now's a great time to be doing that.
And I think one of the key points too is that, again, we feel very optimistic about the market. I feel like we're going to continue to see price appreciation, not 20 to 30% year over year, because that's ridiculous. But even if it did dip, if you're buying sound real estate in good location and with numbers that work, and you're thinking long term, it doesn't really matter if it dips a little bit. Real estate goes in cycles. If you bought back in May here in Portland, you bought at the peak. It's come down. Median home price has come down about 8 to 10%, depending on where. Not every area has come down, right? Just all neighborhood pockets and all that. But if you bought an investment property, unless you were flipping it, if you're flipping it, that's not a good scenario for you. But if you're thinking long term as an investor, and not someone just producing inventory, then it doesn't really matter. If you're carrying it and it's covering itself, you're cash flowing a little bit, just wait it out, and you'll pay down your mortgage, you'll be getting cash flow, you'll get the tax benefits, and then appreciation is going to come back. So
be greedy when others are fearful, and fearful when others are greedy. I mean,
someone really smart said that.
Wasn't it Warren Buffett? Yeah.
I'm not a stock guy, but yes,
in terms of real estate, I mean,
very true.
There's a lot of fear. There's a lot of misinformation out in the news on housing data right now, and really taking a data approach and listening to the right people who are interpreting it and making it digestible.
Make sure that the articles you read are not just some writer that's drawing a conclusion. They're actually qualified to give an opinion. Someone speaking from Moody's Analytics or Lawrence Yoon, economist for National Association of Realtors. Some of the folks you mentioned, they may not all agree, but they're all qualified to have an opinion. A journalist that's taken a chart and saying year over year sales numbers are down, and writing writing an article about it and with a headline about the market crashing,
Mm-hmm.
they may or may not be right, but they're not really qualified to give their opinion. So make sure your sources are qualified and that you're not just taking data and opinions that are thrown at you.
Exactly.
Yep. I think that's a good point to end it on. So I always bash on the the headlines and everything because they're so misleading. But well, thanks for being here again. Appreciate it. Hopefully that was super insightful for everybody. I'll make sure that, as always, your contact information is attached so people can reach out to you. You do work, as a reminder to everybody, you do work in a lot of, you're here in Portland, but you do work in a lot of the kind of more Western markets here.
Yes,
so you've got a lot of ability to help people, not just here in Portland, but
eight states here on the West Coast.
Awesome. Yeah. Yep. So if you're buying as the deals pop up in Phoenix, as the market corrects, call Grant. You do work in Phoenix, right?
Yes, sir.
Okay. Awesome. Well, thanks again for being here.
Yeah, thank you.
Thanks everyone for listening, and we'll catch you on the next one. Make it a great day.